Good morning. My name's Paul Nicol, Managing Partner of GFM Wealth Advisory. A warm welcome to our GFM clients and guests who are joining us for this morning's webinar. An update from Magellan on two of their funds, the Magellan Global Fund and the Magellan Infrastructure Fund. It's an absolute pleasure to have Gerald Stack, who is the Deputy CIO, Head of Infrastructure and Portfolio Manager at Magellan, and Arvid Strymon, Portfolio Manager and Head of Macro at Magellan, joining us this morning to talk about both funds. Now, both Arvid and Gerald are very well known to our clients, having helped us with previous webinars. So this will be an excellent session today. I will formally introduce both in a moment. It's an excellent time to get an update from Gerald and Arvid, as we do appear to be at a critical junction in the global economy and markets. Inflation is slowing, but it's hard to tell if the magnitude of interest rate rises and the lagged effects of these are being fully felt. Meanwhile, markets have shrugged off these concerns and have rallied strongly in the last quarter, driven by the excitement of AI, leading to questions about valuations in a deteriorating economic environment. Now, before I get underway, I have the obligatory disclaimer to make, and that is that today's webinar is general in nature and is not personal advice. By all means, if there's something that we discussed today that you would like clarification on, please make contact with your advisor here at GFM or call our office, and we will be able to answer your question then. So let me firstly introduce both Gerald and Arvid. So Gerald joined Magellan in 2007 and leads the team responsible for Magellan's infrastructure portfolios and providing research coverage of companies within infrastructure, transport and the industrial sector. In 2022, Gerald was appointed the Deputy CIO. Prior to joining Magellan, Gerald was a Director of Capital Partners. Gerald also chairs the investment committee at Magellan. Arvid joined Magellan in 2014 as a senior analyst in the financial team. In 2017, Arvid was appointed the head of macro research and chairs the macro committee. In 2018, he was made a portfolio manager, and in 2020 was promoted to co-portfolio manager of the global equity strategy. Prior to Magellan, Arvid spent 10 years in research departments of Morgan Stanley and UBS, covering financial institutions and economics. Arvid is also a member of Magellan's investment committee. So firstly, good morning, Gerald. Good morning, Arvid.
Hey, Paul.
Hey, Paul.
Thank you for both joining us this morning. Let's get underway with the questions. And I think I'll hand over to you first, Arvid. By all means, Gerald, if you like, please feel free to join in. But Arvid, as I mentioned in my intro, a lot's happened in the global economy and markets since we had a webinar with you last. You know, I'm keen for you to set the scene where we're at now. And when we last caught up, you spoke about the threat of higher inflation and the potential for higher interest rates. This has clearly played out. So can you talk us through what's happening with inflation and particularly in the US?
Yeah, sure thing. So I think you're right. Inflation was a big issue. And I think that if you think back to last year, I would say there were two things that were top of mind. The first was inflation, which was high, and then interest rates, which were going up. Now, if we fast forward to this year, what's the outlook? I think there's two things, okay? First is not so much interest rates going up, but interest rates being high, okay? And I think we can all feel that. And what does higher interest rates do? It slows growth. And I think we all know and can feel the impact of higher interest rates ourselves. I'll tell you a little story. I live just outside of Sydney, and there's this town called Gosford, which is a reasonably sized town. It's got its own homemaker supercentre, which I went there on the weekend. It's on a Sunday about 2 o'clock in the afternoon, usually packed. I had to take a photo because the car park was only 10% full. It felt very, very strange. And I suspect that was almost entirely due to higher interest rates. Okay, so higher interest rates, we know it's slowing the economy. But from a investment perspective, we also know that it's going to be slowing economic growth and slowing profit growth. And you asked about what the outlook is for the US. I would say, given that in America they have the same dynamic of higher interest rates, but it probably doesn't hurt as much because they tend to have 30-year fixed rate mortgages, not the variables or 2 to 3 year fixed rate mortgages, which you have in Australia. But at the end of the day, you're not getting the stimulus to growth that you have in the past. So slowing growth in America, slowing profit growth in America. And if we think about what's going to happen to markets, because ultimately I think this is a key question, it's going to be different to last year, which was an interest rate driven market. This is going to be a market where it's going to be slower earnings growth. And if we're thinking about what really drives equities at a broad level over periods of years, it's earnings and profits going up. And so this year, I'm not sure that we're going to see a lot of strong rise in markets from an earnings perspective. You have seen the markets go up. I'm not sure that's because of earnings, because they have been slowing. So I would say this year, inflation is going to be slowing, and the market's going to feel the headwind from slowing profit growth. Now, when you were talking about inflation is still above where the Federal Reserve wants it to be. It's still above where the Reserve Bank wants it to be. I suspect it comes down towards where they want it to be, but the world never travels in a straight line. I think we all know this. So it's going to be a little bit bumpy, but I think that is the base case. Inflation's under control over a period of time, but there's always bits of the market and the economy which are out of whack, okay? I would say there are two pieces. The first one is the jobs market. And you've got to remember, in America, you were asking about America, Paul, wages growth has been pretty high because you've had about 1 million people leave the labour market, okay? And we know there was a bit because of COVID. Unfortunately, some people died and maybe some people don't want to work. But also immigration's low. We know that there's a lot of people in Congress who don't really want a lot of immigration. So you can see that labour market is pretty tight. And it's hard to fix that, okay? I always tell people it takes about 21 years to fix a labour market shortage, okay? Because that's how long it takes for people to grow up and get into the labour market. The second one's the housing market, and this flows through to rents in America. You can see that the housing market's held up remarkably well, a bit like in Australia. But you go, well, why is that? Well, it's because no one in America really wants to sell their house, because then they'll have to go to a higher interest rate. And also, one thing that's in common with America and Australia is a shortage of housing, okay? And again, it takes a long time for that to fix itself. And I always tell people, back in the early 2000s when I was looking at the Australian economy, I was always telling people there's a shortage of houses in Australia, and you know what? They still haven't fixed that. So I would say they're the two things which are out of whack. It's the job market and the housing market in America in terms of inflation.
Okay, so you've set the scene that inflation is cooling. We know consumer inflation appears to be anchored. We're not sure of the magnitude of the interest rate rises and the lagged effect that this, has this been fully felt yet? So I guess the golden question is there the potential for anything to break in the system, Arden?
There certainly is. And you mentioned we can't be certain that something might not... can't be certain whether inflation's under control and inflation expectations. No one knows the answer to that, okay? And a lot of people will have a view on that, but at the end of the day, no one knows. It's just a view, okay? And I think as investors, you've got to figure out where you have a conviction in a statement you'd make and where you're basically just giving a view. Now, I would put the impact of higher interest rates and inflation, and speaking of specifics, that is something which you can have a view, but you can't be high conviction on what it is. I think you can have high conviction that there's more turbulence ahead. And you referenced some financial stability concerns. Now, higher interest rates, I would argue, caused not only the issues in the US banking system, the Silicon Valley Bank stuff that you saw before, earlier this year, but also the issues you saw in the UK. Now, if you're sitting here and you go, okay, so what was the commonality behind both of those two things? I would say higher interest rates. If you didn't have higher interest rates, I don't think that those things would have happened. And the point being that interest rates are still high. So that is still a risk. Will it occur? Well, that's $1 million question. I think you're alluding to that. But all we can say here is that if you're thinking about a heat map and where the risks are high and the risks are low, I think you've got to say that the risks are high here, okay? The worst thing you can do as an investor is to say, well, I know that higher interest rates are causing stresses in the financial system, but I'm going to go and take some of that risk and invest in there anyway. And then for it to happen, because someone turns around and says, hey, you must be blind. We all knew that this was a risk. So that's really the attitude that we're having towards the banking sector. Our portfolio doesn't hold any banks. That's one of the reasons. There are other reasons, but that's one of the reasons why we are not holding the banks. Because as you say, there are still some issues here, and it's hard to get conviction that they haven't gone away.
So I guess leading indicators are suggesting that we're going to have an economic recession in the US. I think the question I'd like to ask is in an environment of a recession in the US, what type of companies should you look to avoid? You already spoke about the banking stocks. And conversely, what style of companies should you be looking to invest in that type of environment?
Yeah, very important question right now. And here I would say, you're talking about a recession. I think the big debate here is whether it's a deep recession or it's just a mild recession. And this mild recession, people like to call a soft landing. Now, we're in that soft landing camp, okay? And I think this is more or less what markets are pricing, equity markets are pricing right now. And in this soft landing scenario, okay, where your growth's slowing, but it's not collapsing, it's not a GFC, it's not a dot-com bust, it's not a COVID, initial stages of COVID downturn, I think you really want to be in two things, okay? Firstly, you want to be in defensives, okay? Because if the economy is slowing, right, then you don't want to be in things which are going to be hurt by that slowing. Okay, I think this is pretty straightforward. And so I think our portfolio is reasonably well positioned for that because we tend to hold a lot of those types of companies. The second place I think you want to be is in companies that are high quality. And here I like to tell people, you know, when the dot-com boom was happening and maybe there was some speculative excess during COVID, you saw the market really go up. And you know the companies which really did well? Low quality companies, okay? GameStop was up 20 times. Okay, we know this company wasn't really doing that well fundamentally. But when the going's good, I would say that people don't really care about quality. Now, if we're talking about the opposite scenario where things get a bit tougher, then I think it's definitely the case that quality companies will outperform for the same reasons in reverse. Now, here is one thing that in particular I think is a reason why quality companies do outperform, not only when the markets go down, but also in the years subsequent, is because if you have a strong business and the market and the economy is slowing down and you go, hey, you know what? I know all my competitors are under pressure. I'm feeling some pressure now, but I'm going to continue to invest. I'm continue to engage with my customers. And you know what happens when the economy turns the corner and comes out the other side? Your customers love you. Okay, right? And they go, hey, I'd like how you didn't turn your back on me. I see you still have new products coming out, new services. And you always see this time and time again, which is when the market and the economy turns on the other side, it's the quality companies who invested, so it's quality and investment through the cycle, who come out stronger. And I would say this is almost a defining characteristic of a quality company. Okay, and so they're the two things I would say you would want in a let's call it a soft landing or a mild recession. In the worst case scenario, which isn't our base case, by the way, we really think it's that scenario which I was talking about. If we say it's a deep recession, I think you kind of want the same things, but maybe you want some companies which are more benefit more from lower interest rates. Okay, and so we can think of some of those companies. I think Gerald's got some of these companies as well. We can access some of these companies. I think in that more let's call it robust downturn, then you really wanted more defensive companies because we know that in those in that sort of environment that the Federal Reserve, the Reserve Bank, the Bank of New Zealand, the Bank of England, the ECB, they're all going to be cutting rates.
Great. So I think the natural segue question, Arvid, is as the co-portfolio manager for the Magellan Global Fund and our clients being investors in the fund, could you perhaps talk us through the composition of the fund and maybe some of the portfolio changes that you've made in more recent times?
Yeah, sure thing. So there's two things that you mentioned there. How's the portfolio constructed and what we've done recently. So we've got portfolio activity slide on the screen right now. But the first question is, you know, what does the fund do? Okay, and how we positioned in general, because what's on the screen is how it's changed more recently, some tinkering around the edges. But fundamentally, I think you can think of our equity portfolio as having two parts, roughly the same size. One which is a defensive, sleep well at night type of company portfolio, and this is kind of what we were talking about before, with household brands that you can remember and you would recognize. And you know why you recognize them? Because they're strong brands, because they're high quality. It's almost the same thing. So that's one half of the portfolio. The second half of the portfolio, which we would say is our more growthy part of the portfolio, and we can have a mix of structural growth companies, companies that have a very long pathway of growth, and the second part of that growth might be more cyclical growth companies. Now, if you're talking about a scenario where growth is slowing, we might slant more to the structural growth parts of the market, because they're less sensitive to the economic cycle by definition. So that's what we have in the portfolio, and I think that gives us a unique ability to withstand any sort of downturns in the market, and also downturns in the economy, because it's not just a market downturn we're protecting against, it's a economy-wide downturn which really shakes out the losers and the not so good operators in many industries. But if we now turn to talk about what are some of the things that we've changed over the past 12 months, you've got them all in the screen in front of you, but I want to talk about a few of them here. The first is on the left-hand side. These are the things which have gone into the portfolio. I want to call out United Health Groups, because some people may not have heard of this. It's a very big health insurer, but also operator of, let's call it, medical centers, and has a very big network of medical practitioners in America. And the reason why this is really interesting is there are a few of them. Is firstly, it's the biggest company that does this, and some people say it's almost the Walmart, which is a very big supermarket chain in America, the Walmart of health services in America. Now, what they mean is not so much that it's really cheap, but it's everywhere. Okay, it's really big. So that's really important, because we know that in most cases, as a business, if you have scale, it gives you some sort of advantage over your competitors. So that's number one. Number two is you sit here and you go, hey, you remember last year when the US government was trying to argue over raising the debt ceiling? The only reason they were doing that was because they had to borrow more money, because they keep running these budget deficits. Now, we all know that healthcare is one of these pieces of government spending which is expensive, which is growing faster than GDP. So it makes sense to us that the government's going to sit there and go, okay, we can't let this debt problem grow too fast. Of course, it's going to grow. We don't want it to grow too fast. We need to get more bang for our buck out of our health spending. So in walks United Health and says, oh, okay, so what we will help you with, Mr. and Mrs. Congress people, is you pay us a set amount of money and we'll get you better health outcomes for the patients. And the reason they can do that is largely because they've got the scale and they've got the networks. And the government says, that's great because you're helping us out. So healthcare in America, we all know it's a politically charged topic, and there's a problem around the budget. Okay, now when things are politically charged, there's always regulatory risk. So if you're big and you're helping the government out, I don't think you're facing as much regulatory risk as you possibly might be if you weren't helping the government out. I think you see this all the time. So United Healthcare, the Walmart in a breadth sense of healthcare providers in America, which is helping the government. And we know the aging population is going to mean that there's going to be more people that need health services in America. So that one's really interesting to us. The next one is Netflix. It has been in the portfolio before. We like the streaming industry. We think it's a growth industry. And I think we all have some exposure to, streamers. We watch Netflix or Disney Plus or Apple Plus, whatever it is. But again, Netflix, the largest company, streaming company in the world. And again, you got to think about what these people do. They make content or buy content and then try to sell it to as many people as possible. If you've got more customers than anyone else, your per customer cost of that content is much lower than anyone else. So it's almost a self-reinforcing cycle. And so Netflix to us is interesting because of that scale advantage, but they're also doing some interesting things. They've introduced an ad-supported tier, which I think helps them monetize some of their customers, but also, and I think everyone's going to sort of understand what I'm about to say here, a lot of people share their Netflix password, okay? And so from Netflix's perspective, they're sitting there going, hang on, there's a lot of people not paying for what we're giving them. We're going to crack down on that. And I'm not sure whether you or your clients have gotten the email we have, which says, by the way, you can only use it in one house now. Now, all they're doing there is saying, can you please pay more? Okay. Now, what we've seen over the past quarter or so is that people will say, okay, yeah, I'll pay, as opposed to, oh, well, I'm not going to pay because I didn't really think it was that good. So that is almost a confirmation that what they're doing is valued. Okay. If you can charge for it, it's valuable. Okay. And so for us, that is something which I think is almost confirming how strong this business is. I think we all knew how strong Netflix is, but that little experiment I just talked about almost confirms it. On the right-hand side, here's a few things that we took out. I'm going to talk about Procter & Gamble, which makes stuff that you would buy. This is how I explain it. Stuff that you would buy in the supermarket to clean your hair or to clean the house. Okay, so this stuff here is stuff that's a consumer staple type purchase. You have to buy it, but in the past 12 months, you remember the big issue we were talking about, Paul, is inflation. Mm-hmm. Now, in inflation, I don't know about everyone on this call, but I certainly was buying more home branded stuff just because the prices went up. Now, if you don't have a dominant market position and you face the threat of home branded, no branded, no frills type brands, then you're at a competitive disadvantage. So maybe your pricing power isn't quite as strong. So that one we left out of the portfolio. And if we move down that right-hand column, US Bancorp, which is a bank, it's not just the fact that there were these jitters in the financial markets because of higher interest rates. We're also going into an economic downturn. And I always tell people, when it comes to the banks, the one thing that causes the biggest swings in bank profitability is the credit cycle. Or in other words, do people pay you back? Okay. And when the economy is slowing, that risk of you not getting your money back as a lender goes up, and it's exactly the wrong place you want to be. I'm not sure how deep this recession will be, but it's slow or very slow. Okay. Or modest or deep. So there's no real upside here. So the banks are another thing which we've taken out of the portfolio in the past 12 months.
Thanks, Arvid. So the Magellan Global Fund appears to have several major themes running through the portfolio. Do you mind just spending a few minutes talking us through those?
Yeah, sure thing. And I think having the themes running through a portfolio is important, because otherwise I think you just maybe rolling a bit of a dice. I think you have to have some sort of framework for not only identifying companies which are going to grow faster than average, okay? And these are where the themes come from. But at the same time, you've got to have a valuation lens overlay as well, because if something's really expensive and it's going up, it's nowhere near as interesting as something that's cheap and is growing quickly. So here are the fundamental things that we're interested in. I think on the top part of the slide there, you can see that the big thing that I think you can see around the world today is, if you want to think about it in very big terms, is digitalization. And it's not new, okay? When we think about these structural trends, I always tell people, you don't really have to look too far to see them, okay? And they don't really change that much, okay? Because they're long-term trends. Now, digitalization, we all know, okay, we've talked about this for many years, that people are not using coins and notes to pay much anymore. It's the tap and go type stuff. And that's been happening for a while. It accelerated during COVID, but there's still a long runway for that when it comes to emerging markets. I can't remember the last time I used cash, physical cash, but in emerging markets, there's still a big runway. Consumer spending, again, this digitalization, I think e-commerce, this has been around for years, okay? But again, this is something which is still got market share to take from, let's call it bricks and mortar, okay? And we've got Amazon there. I think everyone thinks of Amazon as an e-commerce play, but by the way, it actually has a very big cloud computing business, which is where it makes most of its money. The other thing about digitalization and consumer spending, we've got LVMH as the luxury manufacturer there. As an example, and it's really important, is that consumer spending and digitalization, it's not just about providing a platform, it's also collecting the data on the customer to say, okay, this person really likes, if it's LVMH, they really like handbags and shoes, okay? And if they haven't bought anything in 3 months, then we'll just send them the catalog, okay? And you know what the funny thing is? It works. Okay, and so I think that digitalization in shopping is very powerful. We also know digitalization in the workplace is very powerful. We all use Microsoft for that. When it comes to the Internet of Things, which is IoT, that's a growing opportunity, I would say, and again, not new, and generative AI, which is the thing which everyone's talking about, which I would say is a structural trend as well. But that's the digitalization piece. I also think that you've got the infrastructure piece, and we've got an infrastructure expert here as well who say far more about this than me. But I will just say that I kind of think of it in terms of environmental infrastructure. We know there's money going into decarbonisation. And I would say that there's housing infrastructure as well. We've got Lowe's, which is America's version of Bunnings. And then there's, of course, the normal energy infrastructure and tech infrastructure. And then the last thing that there's almost a structural trend is we want these companies which are just going to compound, which are high quality. Maybe they go into the defensive part of the portfolio, and you're going to say, well, where's the structural trend there? And the structural trend is high quality, rely on them. You know, you want some of these companies in the portfolio. If you look at that bottom right-hand part of the slide, you will probably recognize all of those brands because, as I said earlier, they're high quality brands.
Great. We're going to come to Gerald in a moment with infrastructure, but you just quickly touched on AI, Arvid, and this is something that Magellan's actually been talking about for several years. So have we hit the point now where AI is creating new addressable markets and income streams and likely to accelerate the growth of companies? And conversely, is there a very strong chance this will heavily disrupt industries and companies?
Yeah, I think we are. And this is the way I think about it. Okay. So if you get some sort of breakthrough or discovery, that's one thing. Okay. And people can get excited about that. But what really matters is the implementation of that breakthrough or discovery. And so has the implementation happened? And we all know that there's ChatGPT, but is that really making anyone money? Oh, it's probably more an experiment. But there is implementation happening, okay? And so I think the answer is, to your question is yes, Paul, because the implementation is happening. Microsoft, one of the biggest companies in the world, which we all know, recently said we're going to introduce something called Copilot, which is an AI driven tool, which will help you create a PowerPoint a PowerPoint or a Word document in your Microsoft programs, and they're going to charge $30 per month per user. Okay, and this is happening. Okay, this is the thing, and we've had a look. You can YouTube it and see what it does. It's amazing. Okay, it's going to save so much time. So I would say yes, it's happening. What's going to be disrupted? Well, I kind of think of it as the same as the disruption you've seen in asset management from active managers who just hugged the benchmark. They all found out that they weren't adding much value. They were just kind of just copying the benchmark. So when it comes to white collar service employees or workers, those people who do stuff which really isn't that complicated, I think they're the first ones to go. And just like in the asset management industry, the people who create the alpha and who really take the risk and have that edge, I think they're safer. The people who are just procedural, I think they're less safe.
So, Arvid, I wouldn't mind just spending a couple of minutes looking at one company in the Magellan Global Fund portfolio, and that's a company that I find particularly interested, which is ASML. Do you mind just spending a couple of minutes talking about why you own ASML in your portfolio?
Yeah, sure thing. So ASML, it's a Dutch company, and I describe it like this. Okay, and we got a picture of some transistors and semiconductor chips. So the most complicated semiconductor chips, you know where you find those? In your iPhone, okay, or your phone. So that's where they go. But the question is how you make them, okay? And you can see at the bottom of the slide, there's more or less 3 steps. You need the equipment that's going to make it. You need the people that actually operate the equipment. And then you also need the people who design the chips. Now, ASML is an equipment provider. And you've got to think, where do all these chips come from? They come from these big factories, essentially. They're called fabrication plants or foundries sometimes. They're the size of 30 to 40 football fields. They cost about $10 billion to build. They're full of really smart people with PhDs and really, really complicated pieces of equipment. Now, what ASML does is it makes the complicated equipment. And this is the thing about the technology, is that it's so cutting edge that not many people can spend the amount of money to do the research and development or R&D to stay at that cutting edge, okay? And when you get to the cutting edge, which is more or less the chips which go into your iPhone or your Android device, the machines which make those chips are basically all coming from ASML. Okay, so it is a virtual monopolist when it comes to that part of this semiconductor value chain. And if we can just illustrate how hard it is to catch up, China, as a country, not a company, but a country which is way bigger, is trying to reverse engineer or create these types of machines. And it can't, okay? And there's a big debate as to whether they'll actually catch up. The issue is not only that the technology is so complicated, but the technology is moving so fast. So you don't actually have to just catch up. You have to catch up and then catch up again because of the things moving. So we look at the company. We've got a double-digit forecast return on this company, which is attractive. I think it's unique. It's attached to a structural trend, which I think we can all understand, which we think is durable. It's a high-quality company, and it's very hard for a country or even a company to try and compete effectively with ASML. So that's what they do, and that's why we like them.
Thanks, Arvid. I'm going to ask you about valuations at the end of this, leave it to the end. So I'm going to hand over to Gerald now because I'm really keen to talk about infrastructure. Gerald, as you know, GFM, we are very strong advocates for having infrastructure in our clients' portfolios. But infrastructure is a very generic term, and I'm very keen for you to talk about what infrastructure refers to and how Magellan defines infrastructure.
Okay, thanks, Paul. Look, by virtue of being an infrastructure investment manager, I'm always making the case for infrastructure having a position in the portfolio. We're grateful for GFM's support and your clients. The way that we think about infrastructure is that it's about delivering very reliable returns over time. So Arvid's talked a little bit about quality companies there. When we talk about quality, we're really meaning that you can trust the nature of the returns for a long duration into the future. And you're not going to find anything that's giving you more confidence, I would think, in terms of underlying earnings than most of the companies in which we invest. When investors come to define infrastructure, they tend to use the term essential assets that provide services that are essential for the efficient functioning of communities. And the demand for those services, the supply of water, the supply of energy, supply of transport, very reliable over time. You know, the economy will go up, the economy will go down, but the consumption of water doesn't really change that much. So the demand for these services is incredibly reliable. And that's where the investors generally think about infrastructure. What we do, and if you take that definition, you see what we've just shown you on that slide there. There's about 350 companies across different markets around the world with a market cap somewhere north of $4 trillion. And to give you, by comparison, the Australian Stock Exchange, somewhere between about 2 and 2.5 trillion. So it's about twice the size of the Australian Stock Exchange. Smaller number of companies, larger market cap. So that's the potential universe. What we do is to take that universe and to say, well, look, ultimately investing in infrastructure, the magic here is not in the physical construct of the assets in which we're looking at. The magic is in the risk and return characteristics. It's about investing in a very high quality set of companies. So what we do is to take this group of companies and we'll screen out anything which, while it may face very reliable demand, doesn't end up with reliable earnings. And so we talk about external variables that affect earnings. And the things that we're typically focused on are things like competition, commodity price influence, and sovereign risk. So these are issues which can mean that, yes, you face reliable demand, but you don't face reliable earnings. So to take competition, for example, if we think about electricity in Australia, I think we'll all agree electricity is an essential service. But if you're a power generator and you're not regulated, and the companies aren't regulated in Australia, then the price of electricity in Australia changes every minute. And the average price of electricity in Australia is about $90 a megawatt hour. But compared to that average price, the maximum price is about $15,000 a megawatt hour, and the minimum price is negative $500 a megawatt hour. So you've got a price that jumps all over the place, and therefore your revenues and your earnings are not reliable. So we don't want to be in that. Transmission and distribution are the next two parts of the value chain that get the electricity from the power generation company to the end consumer. And they are natural monopolies providing an essential service. And this is a common theme across infrastructure, natural monopolies providing essential services. And as a result, they are typically regulated. And regulation for us is our friend. It means we're not going to take advantage, if you like, or the maximum advantage of the monopoly that we have, because the regulation limits you to a fair return. But it means you've got very reliable returns over time. When the economy turns down, the regulation can protect you just as much as on the way up. it acts as a hindrance to your total return. So it means you get very reliable returns over time. And this is the nature of infrastructure. So we want to avoid competition. We want to avoid anything with a direct linkage to oil prices. And we want to avoid those things with sovereign risk. So which really means for us, no China, no Russia. China has incredibly attractive themes as it pertains to infrastructure. You build a toll road in China, they will come, but you may not get traffic. You may not get cash flow, that is, because the government may interfere with your rights. And they do that for very good public policy reasons. They're not willfully coming to get you, as it were. But in a jurisdiction like Australia, if the government does that, then you get compensation, whereas you don't get that in those jurisdictions. And for us, again, to go back to the underlying basis of infrastructure, it's about very reliable returns over time. It's not get rich quick, but it's about growing your wealth with a very high degree of confidence. And we would take the view that in a place like China, we haven't got the requisite level of confidence. So we're going to avoid that. So then what are we left with? We're left with about 130 companies, 130 to 140. It's probably close to 140 companies today across the different markets, with a market cap of somewhere north of $2 trillion, so about the size of the Australian Stock Exchange. About 60% of that opportunity set sits in the utilities bucket, about 40% in the transport and social infrastructure bucket. Social infrastructure is a very small part of the listed environment. There's really only 3 companies that we've identified that meet that criteria. Big part of the unlisted environment, because there's a lot of hospitals and schools that get funded through private ownership. But typically the funding of those assets or the revenues from those assets come from government. They're very reliable. They tend to have a very high level of debt and very low levels of equity. So that you don't tend to find too many of those in the listed space. So really our universe is 60% regulated utilities, 40% transport infrastructure. And that's where we're going to play. As I mentioned, not get rich quick, but about growing wealth with a very high degree of confidence. We can be, I think, extremely confident the nature of earnings from these companies in 5 years' time is going to be well north of where it is today. And if I take the regulated electric utilities, typically they're giving 5-year earnings guidance of about 5 to 7% per annum. There's 2 things to take away from that. Firstly, there are very few companies in the normal environment who are going to give you 1-year earning guidance, let alone 5. So these guys are so confident about their earnings, they're going to give it for 5 years. And they're doing it within a 2% band, 5 to 7% growth per annum in their underlying earnings per share. So that's how confident they are in this business model. They're very, very confident that they're going to grow their wealth at a reliable clip over time. In any given year, that's not going to be too exciting. I'm fond of saying in the infrastructure world, if we've got excitement happening in our work life, then we've got the definition wrong. This is about very boring, reliable earnings with a very high degree of confidence over time.
Thanks for that tremendous explanation, Gerald. Look, it's been a challenging period of recent times to be an investor in infrastructure, with central banks increasing interest rates to curb inflation. Can you provide some context on why a rising interest rate environment can offer headwinds for investing in infrastructure?
Yeah, so Arvid's talked a bit about interest rates and I guess inflation as well already. The key for us in thinking about interest rates and inflation are the impacts on the business and then the impacts upon valuation. There's 2 very different buckets to think about this. If we think about the impacts upon the business, an increase in inflation is going to typically lead to an increase in interest rates as central banks jack up rates to try and cool the level of activity, as Arvid's talked about this morning. If you think about our businesses, they're regulated, and the way the regulation typically works, there's 2 buckets of our businesses. There's regulated utilities and transport infrastructure, toll roads and the like. For regulated utilities, if inflation's going up and interest rates are going up as a consequence of that, you go back to the regulator and you get an increase in the price for your service such that your earnings are protected and they're protected from that impact. So you're very much protected from that. If you're a toll road or an airport, you've got a similar thing going on. Typically, your regulation happens through price. Most of your clients will be conscious of the fact that Transurban's toll roads, the price on those things grows with inflation, or sometimes a little bit more than that. And that happens automatically every quarter. I'm fond of saying, 1 April, 1 July, 1 October, they're very fond days for me every year because they're the days that tolls go up on Transurban's toll roads. So when you hear that beep on the 1st of April, it's not just telling you it's April Fool's Day, it's your tolls have gone up and it's just automatically transmitted into your into Transurban's bank account as you've gone through the toll plazas. So there's automatic indexation of these things. So these businesses are protected from that inflation and interest rate rises. Indeed, in an inflation, to the extent that inflation is a consequence of increased demand of an economy that's heating up, inflation is probably a good thing for toll roads and airports, because it means you're getting, while prices is a pass-through, you're actually getting more volume. You're getting more people through the toll gates. You're getting more people through airports. So it's actually a good thing. So our business is very much protected from that. So therefore, the issue that we need to think about then is valuations. And when we think about valuations, it goes back to the two elements here. Interest rates are going up, inflation's going up. To the extent that we've got equal changes in there, in other words, real interest rates are constant, then the impact upon valuations, on intrinsic valuation, on fundamental valuation, is actually pretty limited. We would see value as being largely unaffected, if not anything slightly positive to an increase in inflation and interest rates, where the increase in rates equals the increase in inflation. Where real interest rates rise, and that's a bit more of a difficult proposition. To the extent that real interest rates rise, then we're not getting full compensation from that in our revenues and our earnings, and therefore that has a heavier impact upon value. And if we look over the last 10 years, we've probably seen 4 major increases in rates over that time, which observable increases in rates. Each of those times, interest rates have risen by around about 1%. And the most recent one we saw, the first 3 of those 4 occasions, nominal rates went up by 1%, real rates basically stayed stable. In the most recent bout, we've seen nominal rates go by probably more like 1.5%, and real rates similarly also go up by 1.5%. So I'll come back to that one. But the first 3 situations, nominal rates went up. We saw a very knee-jerk reaction, very quick reaction to infrastructure prices. They were down sort of 5 to 10% in each of those 3 occasions over around about a 1 to 2 month period. But over the following 2 months, infrastructure values came back to what we would expect. So you get this knee-jerk reaction, but very quickly the fundamentals re-establish themselves as we would expect, and you come back to fair value. So in other words, nominal rates and inflation, to the extent that they rise, you probably see some short-term impact. The market and practitioners, the sell side in particular, brokers and the like, will tell you that infrastructure is impacted by this stuff. So you see that impact in the short term, but very quickly it comes back to what we would expect. And if anything, generally we would see this as a buying opportunity. Now, when real rates rise, when we saw rates go up last year, they essentially, around the world, real rates went from 0 to about 1.5%. And what we saw there is it was an impact upon valuations. And this is we're going to see this with anything with long duration, anything with got very long period of cash flows out into the future. The compounding effect of those interest rates impacts the value that you're getting from those cash flows. So as a result, an increase in real rates will hurt valuations, and basically an increase in real interest rates. As I said, today, real interest rates about 1.5%, 1.75% in the US, Australia, and the like. An increase in real interest rates of 1% would impact values to about 10%. That's the sensitivity. So we would think today at 1.75%, there's probably as much upside risk as downside risk in terms of real interest rates. And so we think the position's relatively well balanced. At 0, where we were 18 months ago, we were allowing for real rates in our valuations in the way that we think about our world. We were allowing for those rates to get to 1%. They've gone a little bit further than that. And as a result, infrastructure values have come off a touch through that period. But from where we sit today, we think it's pretty well balanced.
As at the 30th of June 2023, Gerald, the Magellan Infrastructure Fund had a slight bias towards infrastructure companies over utilities. I'm curious to know why.
Yeah, so as I mentioned, there's really 2 buckets that we can invest in. Regulated utilities and infrastructure is the other one. On the chart there that's in front of people, the yellow and the orange parts of the pie are utilities, regulated utilities, and the blue and the grey is infrastructure, transport infrastructure, assets involved in the transport of people, data and goods. And as you rightly point out, 52% infrastructure, 45% utilities, about 3% cash, slight overweight to infrastructure. Now, regulated utilities provide you a very reliable return, a fair return, but within a very strict band. We'd probably say today the fair cost of capital for regulated utilities, about 9% return on equity. So in other words, for every $1,000 you invest in those companies, you probably should get around about a 9% book return. These assets trade a little bit higher than book value, so you're probably going to get a little bit less than that, probably 7 to 8% over the cycle. So that's what you expect out of these utilities. If they do really, really well, instead of 9%, they might do 10. If they do really, really poorly, they might do 8 instead of 9. So you've got a very tight range around those companies, provided they perform to thesis over time. On the other hand, infrastructure, as I mentioned before, gets regulated at the point of price rather than earnings. So price will typically be locked in with inflation, and therefore, to the extent that we can identify infrastructure assets who've got growing patronage, passengers on a road, passengers through an airport, data through a communications network, if that's growing at a consistent rate over long periods of time, then some of these assets will earn high and growing returns on capital. So we've tended over time to be roughly 50-50 infra utilities, which relative to our universe is overweight infra, because infrastructure is roughly 40% of our universe, and slightly underweight utilities. We're sitting a little bit above that in terms of infrastructure at the end of the period, because of the performance really of toll roads and airports through the last 6 months, if not the last year. Airports had, as the world has progressively opened up, airports had a strong growth in passengers, and that's led to strong financial performance through the period. Toll roads not dissimilar. Toll roads didn't suffer the great declines that passengers did. There were some declines, but they've recovered relatively quickly. But we continued to see a recovery as different cities opened up over the last year. And that's led to consistent performance out of toll roads. So the strong performance of those assets has led us to be more optimistic about some of those things, and we've allowed those parts of our portfolio to grow with underlying performance through the period. So we're talking Transurban, we're talking AENA in the airport space, for example, and that's led to a slight growth in that part of our portfolio. We remain of the view that airports and toll roads remain the most attractive sectors for us to invest in, and you can see in terms of that pie chart that they dominate that infrastructure part of the portfolio. On the other side of the equation, we've got integrated power and transmission and distribution in the utility bucket, which comprise the bulk of our utility exposure, probably something like 37-38% of the total portfolio sits in those two portions, which are both electric utilities. And we like electric utilities because of the opportunity to benefit from the transition to net zero, something we might talk about later on.
Yeah, well, actually, great segue. Arvid mentioned this before, Gerald, but I'm in the transition to a net zero economy, what does that mean for the earnings opportunity of the regulated electricity utilities?
Yeah, so in different places around the world, we're talking to investors, they have different attitudes to whether or not we need to transition to net zero, but I can tell you that it's going to happen. Governments are quite determined. And what we're showing you there on the screen is the IPCC assessment of where carbon emissions come from. And essentially the bit in yellow, or orange, is what comes from electric utilities. Electricity and heat production accounts for 25% of carbon emissions. And for the world to get to net zero, those emissions need to go to, essentially to zero. We need to move from fossil fuel fired energy to renewable energy. And the best estimates are that, yes, the world has done a lot of investment in renewable energy. We probably need to do about 10 times as much as we've gone so far in the period between now and 2050. So massive investment in renewable energy, and that renewable energy will then need to be connected to the grid to enable the users of electricity, which is the remaining 75% of carbon emissions, to electrify over time. So that's, in essence, there's this massive opportunity to build renewable energy and then to connect it to the grid and to invest in the grid. A significant investment required both in transmission and distribution. And the chart we've got there, or the table we've got there in front of you, is just explaining a little bit about the US. If the US is to get to net zero by 2050, they need to spend in new generation capacity somewhere between 3.4 and 6.2 trillion over that period. And then just in transmission, we haven't included distribution, somewhere between 2.5 and 3.7 trillion of new capital expenditure in their capacity. So if we take the lower end of that range, the 3.4 in renewable energy and the 2.5 in transmission, that's roughly $6 trillion. And that $6 trillion, we're going to spend that over the next 30 years or so. So that's roughly $200 billion a year that's got to be spent. This is just by US regulated utilities at the low end of the range. They're going to spend $200 billion a year. Now, to give you a sense of that, in 2021, They spent a record amount in the US on capital expenditure from electric utilities. They spent $134 billion. So compared to that record amount, they've got to spend at the low end of the range, $200 billion, which is roughly a 50% increase on where they're currently at. So and they've got to spend that for the next 30 years. So there's this massive expansion opportunity in terms of building their capex through time. And to understand about regulated utilities, the regulator allows them to earn a fair return on the capital they invest. In other words, the total amount of their capital base is the number one key driver of their earnings over time. The other driver is the regulated rate of return, and that's been relatively stable through time. So these guys are going to increase their capital base at a rapid clip over the next 30 years. And as a consequence, this is why we see this part of our portfolio, transmission and distribution and integrated utilities, as offering significant opportunity. It's a big beneficiary of the transition to net zero. Now, they're regulated utilities, so they continue to make, a 9% return on their capital base, on their equity. But the bulk of these guys in the US certainly give you, as I mentioned before, 5-year earnings guidance of 5 to 7% per annum. So you're going to compound your EPS at 5 to 7% per annum for at least the next 5 years. And we would think probably something like the next 30 years as the scale of this capex progressively rolls out over time. So we really like that piece. It's, again, not get rich quick, but you're going to compound your rate of return at a consistent rate for long periods of time into the future with a high degree of confidence.
Right. You've already touched on the portfolio's biggest position, Transurban. So if you wouldn't mind, Gerald, one of the areas I'm really interested to talk about is airports. And I know one of the significant investments in your portfolio is in AENA. Do you mind just spending a couple of minutes on why you're an investor in that company?
Yeah, so obviously in 2020 we had pretty massive declines in underlying passengers around the world. Basically, passengers going through airports fell 98.5% at that point. Today, around the world, in the month of May, where passenger numbers were 4% below 2019 levels. So we've pretty much had a pretty solid recovery through that period. Now, so passengers generally 4% down. Domestic passengers around the world actually up 5% versus 2019. So international down 9%. So it's international that's suffering. And then if we look at the different markets, we take North America, Europe, and Asia Pacific, that accounts for about 85% of global passenger numbers. North America and Europe are basically back to where they were in 2019. North America slightly above, Europe slightly below. Asia Pacific 15% down. So Asia Pacific is where the world has lagged. And of that 15% down, it's actually international. That's the drag. International in Asia Pacific in the month of May was down about 30%, international passenger numbers. So I guess the message from this is that passenger numbers are coming back. People do want to fly. And in most markets, it's pretty much back to where it was. And there's another kicker to come as Asia comes back, particularly China, Japan, South Korea. These are big international travel markets. So that's playing out. Now, how does this pertain to AENA? Probably not a huge amount, to be brutally honest. AENA owns 46 airports in Spain. It's essentially the Spanish airport system, and 23. It also owns interest in 23 international airports. But essentially what you're investing in is the Spanish airport system. The Spanish market is dominated by leisure. That's why we've got a significant portion of it in our portfolio. It has a much lower weighting to business. So globally, business travelers have historically accounted for 25% of passenger numbers. In the case of Spain, it's about 10%. So it's a market dominated by leisure with significant exposure to low-cost carriers. And we like this we like AENA for a couple of reasons. One, it's that leisure focus. This is the market that we felt would come back pretty quickly post the pandemic. And secondly, because of the exposure to low-cost carriers, to the extent that we face a recession, what we've typically seen historically in recessions is people go for a trade down. So they go to the lower cost opportunity set, and the bulk of the Spanish tourism is around low-cost carriers coming from Europe, short-haul traffic coming from Europe, and as a result, you can be optimistic and positive about the nature of the passenger trends as we move forward. Now, AENA's passenger numbers across those 46 airports have been above 2019 levels for about the last 6 months. So it was one of the first airport companies to really bounce back. And we think the outlook remains pretty positive for it. So hence, AENA is somewhere north of 5% of our portfolio. It's our number one airport position. We think they've done a tremendous job, both on the cost front as well as the revenue front. And we think they're well positioned to benefit from continued growth in tourism.
Terrific. So we're nearly at the end of the webinar. So I've got one last question for both of you, and I guess it's going to be the $1 million question. So Arvid, I'm going to start with you first. So after a strong run in the last quarter in global markets, how are you feeling about valuations in markets?
Yeah, okay, interesting question. So what is the market's about 1/3 up on their peak, which is around October last year. Market in general, I would say is fairly fully valued for what is the most likely outcome here in terms of some macro sense, which is a soft landing. It certainly looks as though the Fed may walk the ridge line, thread the needle, whatever you want to say, however you want to describe that. And in that case, given that that is what is priced in, and remember the markets have risen, so they've come from a bearish place to let's say a neutral to slightly bullish place. It's hard to see them rising further here unless you get growth surprising to the upside. Now, if you're going to get that, you need inflation to really go away, because growth usually equals inflation. And so the only way I think this really happens is if you get a positive supply shock. We talked about the issues in the US jobs market and housing market. You basically need more supply there to really get growth without inflation. Now, that's from a very sort of top-down perspective. The other thing I would say here, it's always really important, because when you're talking about markets and market outlook, you've really got to think about what's happening within the market as well. So over that period where markets have risen, I'm talking about global share markets, over that period where global share markets are up by 1/3, 20% of the market, 20% of companies here, so I'm talking about number of companies, not value. So 20% of companies are actually flat to down. Now, some of those companies might be flat to down because they've, not performing so well. But I always tell people, right, when the market's going up, there is always something going down. And when the market's going down, there's always something going up. Okay, so we can talk about, as we have, what might happen to the aggregate market. But I think what's really interesting for investors is in addition to that, is to find those things which, for whatever reason, people don't love, people don't like, and are cheap, basically, because I think that's where you're going to make money more easily with respect to whatever happens to the market.
And Gerald, same question for you. Now, I know there are so many different subsectors of the infrastructure market, but broadly speaking, how are you feeling about valuations in the
infrastructure? Yeah, no, I'd be on the same page as Arvid. I think, we think it's relatively fully priced for the base case opportunity set. But we think there are particular opportunities around electric utilities, as I've talked about, because we don't believe the duration of their opportunity is truly appreciated. So we think there's opportunities there. We think airports are probably the cheapest part of our universe and remain attractive in that continued global opening up of the airport system. Also the most volatile part of our universe. So in a recession, a deep recession, they would probably hurt a little bit. But in that base case of a soft landing, we think they're pretty well placed as we continue to see some opening up. And we also think toll roads remain underappreciated for the opportunity set that they deliver in a world where interest rates are going to be a little bit higher and there's a little bit of inflation around. Toll roads are actually really well placed to benefit from those sorts of trends. So we think there are core parts of our universe. There are opportunities there, but we would say our total universe, we think, is probably fair value generally.
Right. So Arvid, Gerald, we're out of time now. I on behalf of the GFM team and the GFM clients, I'd like to thank you both for your generosity of time today and your excellent explanations. And moreover, thank you for all your efforts in assisting our clients in the areas that they invest with you both. So thanks for your time.
Pleasure.
Cheers.